Hello, my name is Chris, and I'm a mortgage broker, and I've been getting a lot of questions about DTI lately, so I'd like to go over that today. So what does DTI stand for? DTI stands for debt to income. Why is DTI important? The reason it's important is because lenders use this ratio, the debt to income ratio, as a way to measure your ability to manage the payments you make each month and repay the money you have borrowed. So your debt to income ratio compares how much you owe each month to how much you earn. Specifically, it's the percentage of your gross monthly income, pre-tax, that goes towards payments for rent, mortgage, credit cards, and other debt. The first thing to know is that different loan types have different max DTI ratios. For example, VA loans are variable and based on residual income, and that's a discussion for another video. FHA loans have a DTI max of 56.99%, conventional loans are 50%, USDA loans are at 41%, and jumbo loans are typically 45%, but it depends on the lender's guidelines. So now let's look at an example of a borrower trying to do a conventional loan. If you were to make $72,000 a year, we would take that number and divide it by 12 to get your monthly income. That would be $6,000. So if we take that monthly income and multiply it by 50%, or the max DTI ratio for a conventional loan, we would get $3,000. This $3,000 number is the total number of monthly debts that lender will allow you to have, including your mortgage, to qualify. Now, this doesn't mean that you will always qualify. There are other factors, but you cannot qualify if you have a DTI ratio above 50% for a conventional loan. Now that we know that the max amount that you can spend towards your debts is $3,000 a month, the next step is to take out your personal debts, which could be things like your car loans, student loans, credit cards, personal loans, other mortgages, and anything else that may show up on your credit report. Now let's say you have a car payment of $300, $250 in student loan payments, as well as an additional $200 in monthly minimum credit card payment. The next step is to add all of these together, which would be $750. So in our example, the person makes $6,000 a month in income and can use 50% of that, or $3,000 a month, towards their monthly debts to qualify. So if they have $750 in other payments or debts, that would leave $2,250 that can go towards a mortgage. The mortgage payment would include any principal, interest, taxes, or insurance payments, also known as PITI, as well as any HOA dues if you happen to be in a condo or a townhouse. This is why it can be harder to qualify for larger loans in certain areas with high property taxes. I put a link below for you guys of a DTI calculator that can help you guys calculate this on your own. We're also going to be coming out with more videos in the future, so if you'd like to be notified of those, please like and subscribe.